I'm Kristen Orman, Research Director for the Oxford Club, and welcome back to Buy or Buy. Today, let's talk about Google, officially known as Alphabet Inc., ticker symbol GOOGL. The all-knowing technology company is commonly seen as a stable, long-term growth stock, but stability these days is almost a mirage, and Google's supremacy is starting to crumble. Recently, shares of the search engine slid 9% in one day after a botched reveal of Google's AI service, Bard. Now, product failures are no stranger to Alphabet, as I'm sure many of you are watching this video on your Google glasses. However, the company now finds itself on the back foot against Microsoft's OpenAI and ChatGPT, a service so powerful it has literally helped me write part of this script. The AI war will be even harder to fight after Google endured a brutal round of layoffs, letting go of 12,000 workers, or 6% of the company's staff. Heck, even some executives are leaving, as longtime YouTube CEO Susan Wojcicki recently announced her departure. So the question is, with volatile and oddly competitive times ahead, is Alphabet still the steadfast stock to keep your portfolio alive? Or is it time to Google search for other tech companies to buy now? Let's start with the bull case. 1. Everybody loves Google, the undisputed leader in internet search and advertising. It's all about the search engine, baby, and Google is the big kahuna when it comes to searching the internet. In fact, its search engine is so dominant that Google became a verb in 2006. Be honest. When's the last time you searched something on Ask or DuckDuckGo? Google and browsing the web are synonymous because it owns 90% of the global search market share. As its users become entrenched in more and more of its offerings like YouTube or Gmail, it becomes less likely that the search engine will lose them. And its market dominance has made the company one of the largest in the world. In 2022 alone, Google generated nearly $283 billion of revenue. That's up nearly 10% from 2021. That's a tremendous growth rate given Google's massive revenue base. Google Services brings in more than 89% of Google's revenue. Most of that comes from advertising, by the way, those certain sales offers that make it seem like Google is listening to your conversations. It literally funds the losses in Google's cloud division and what the company calls other bets. No one is going to usurp Google's search engine dominance anytime soon. In fact, most competitors stopped trying to compete years ago. 2. Google has called back up the big guns. According to a recent New York Times article, Google is not sitting back on its laurels while Microsoft hogs all of the AI spotlight. They've called in Larry Page and Sergey Brin, Google's founders. The pair was spotted meeting several times with executives at Google's headquarters in December. The topic of those meetings? A rival's new chatbot. Larry and Sergey haven't spent much time at Google since they stepped down from their daily roles in 2019. It's said that the founders reviewed Google's AI strategy and pitched ideas to add new AI features to Google's search engine. The company is expected to debut a number of these product plans at Google's company conference in May. These include a third version of AI Test Kitchen, an experimental app for testing product prototypes, a new feature called Shopping Try-On, and YouTube green screen feature. 3. Investors love Google stock. Google is a popular stock among both retail and institutional investors. Wall Street analysts love it too. Today, 46 of them give Alphabet a buy rating. Just 5 of them say hold, and none of them call it a sell. Such a diverse and loyal shareholder base gives the stock a lot of support, especially here near the bottom of its 52-week range. But before you open up your brokerage account and wallet, let's take a look at the bear's case. 1. The economy is bad for business. Google makes most of its money selling advertising space, but a lot of advertising is a discretionary expense at most companies. The bears say that if the economy tanks, or worse, goes into a recession, they'll pull back ad spending, way back. That means revenue and profits at Google will fall. While investors are already expecting a pullback, a more severe or longer than expected ad spend decline will sink shares. 2. Late to the AI party. The bears point out that Microsoft's ChatGPT sparked a code red at Google in December, and for good reason. Microsoft's AI is likely to disrupt search as we know it, leaving Google in the dust. The same way Google is synonymous with searching the web, ChatGPT is quickly becoming the go-to for AI. And after Bard's hiccup during its unveiling, Google will need to spend heavily to defend itself against it. These capital expenditures will eat into profits as revenue growth continues to slow. 3. Even more competition. The bears also believe that competition for Google's search engine business is rising rapidly, and it's not just coming from Microsoft and AI. It's also coming from unexpected places. Believe it or not, TikTok, home of the 2-minute dance video, is increasingly being used as a search tool. TikTok is also challenging Google's YouTube and even YouTube Shorts. As some of its users discover new ways to search for information on the web, it could make Google's offerings obsolete for a large number of users. So is it a buy or a buy? Well, before I reveal my verdict, be sure to subscribe to the channel so you don't miss another video from the Oxford Club. And if you have any companies you want me to analyze on buy or buy, leave your suggestions in the comments below. Okay, back to Google. Look, AI is still in its infancy. It's still too early to judge what, if any, impact it will have on Google's bread and butter search engine, and it's too early to decide which company will create the best AI technology. With shares sitting near 52-week lows, I think that Google and its parent, Alphabet, are a buy. B-U-Y. Even if Microsoft is the first to bring its AI chatbot to market, that doesn't mean it'll be the ultimate winner. I expect that we'll all be Googling for many years to come. The company has found a way to offer users free products and services that they can't live without, and make hundreds of billions of dollars advertising to them. Although advertising spending may decline, I believe that the downturn will be temporary. Over the long run, digital ad spending will continue to grow. It's a great business model, and the company has a wide moat, so Google should be extremely profitable for many years to come. Remember, these stock recommendations aren't tracked in any model portfolio. So if you want to grab shares, size your position accordingly, set a trailing stop, and never bet more than you can afford to lose. Thanks for watching Buy or Buy. I'll see you next time.